Do you want to know how to buy real estate without having to worry about whatever your W-2 income is to determine whether or not you qualify? Well, then you're going to want to watch this video, because in this video, I'm going to show you how to get into real estate without regards to your W-2 income, and additionally, how you can buy in a limited liability company. All right, let's get started. All right, so here's the deal. This is how I've been buying real estate for many years. It's using a very particular type of loan that allows me to buy real estate, and that loan is based upon the income that's generated from that property. So my personal income, my tax returns are not required. In many cases, I do not have to give a personal guarantee. And more importantly, I'm allowed to close in a limited liability company. So it checks all the boxes for me as a real estate investor when it comes to buying real estate, because as you know, when you get into certain types of loans, they start looking at your debt to income ratio, and this can limit how many loans you qualify for. Freddie Fannie stuff, they have those 10 packs of loans. You've heard that number floating around out there. Well, this particular type of loan is referred to as a DSCR loan, which is a debt service coverage ratio type of loan. Let me show you how it works and why it may be beneficial to you. The DSCR loan, it's pretty simple. What the lender's going to do is they're going to look at the property and figure out what is its net operating income. So you take the income from the rents that are coming in, you subtract out the expenses, and all you're going to do is divide it by the mortgage payment. Once you do that, then you make a determination as whether or not this property can qualify for this type of loan that gives you the benefits that I was just describing. So of course you're going to have to buy right here in order to do this. But I also want to throw out there as well, before we move on, is that with these types of loans, not only is it for new purchases, if you have an existing rental property and you want to refi the current note on that property into one of these types of loans, you may be able to do that as well. So there's lots of things you can do. If you just bought a new property and you're wishing you would have had this type of loan, typically you're going to need a 6-month seasoning period before you can refi out of that existing loan into one of these types of loans. Now, how does it work? Okay, so what we do here with the DSCR loan is you're going to take your net operating income. So the income that's generated by the rents minus the expenses associated with the property, taxes, insurance, and things like that. Let's say in this example, it amounts to you make $20,000. And guys, it does not matter what these numbers are. Only thing we're looking at is this ratio, because that's going to determine, and I'll walk you through that, how this works. So you make $20,000, your mortgage payment, what you're going to pay on an annual basis to cover the mortgage for the type of loan you're applying for, let's say it's $16,000. So this is all we do. We take your net income, divide it by your mortgage payment, and we determine what that number ratio is going to be. In this example, what's that? 20 divided by 16, that's going to equal 1.25. So that is our ratio number. Now, this number is important because it fits into whether or not you're going to qualify for this type of loan. So as you can see here, I put down, how it works. You'll hear a lot of people talk about you got to have that number equal 1 or greater. Now, in my experience, it's typically 1.1 is the threshold. But right now, what I'm seeing in the market, it's creeping up. It's going up to 1.2 or 1.3 in order to qualify for this loan. So if you're under 1, it's bad. You're never going to get it. Okay, so in mine, it came in at 1.25. So that puts us right about here. So that's probably going to qualify for one of these types of loans. But I want you to keep in mind that when you're applying for this type of loan, the greater the ratio is, the better off the loan terms are going to be from an interest rate perspective. So right now you're looking at rates that are hovering around, say, 9%, and they go down to probably 7.75, right around there. So if you came in at a 1.1, if you found a lender who's really willing to underwrite this type of loan and their minimum ratio is 1.1, you know you're going to be paying a higher rate. Whereas if you get over here at 1.5, then that rate's probably going to go down, because what it's telling the lender is there's lots of padding there in this loan, that we have plenty of income to make sure that that debt service is always going to be covered by that particular loan. So those are things you want to calculate when you're considering applying for this loan, whether or not that ratio here fits, above 1.1, 1.2 and higher. It's going to be an opportunity for you if you want to go down this road. Now, how does it work to apply for one of these loans? What are the factors that are going to go into it? Well, what I told you earlier, I started off saying, hey, it doesn't matter about your income. That's correct, because this loan is all about the income generated from the property, not how much money you're making from your W-2. which is really good because, with a lot of traditional types of loans, Freddie Fannie stuff, they look at your income, they run your debt to income ratio, and they look at all your loans, and that can impede your ability to get into deals. What I like about these loans is that many times you can close directly in a limited liability company, which you can't on those other types of loans. And on occasion, you're going to be able to find lenders who will say, hey, we don't even need a personal guarantee. So now I'm not at risk in case something goes wrong with that property and I can no longer make the payments. Maybe something's discovered on the property, it's environmental contamination, the tenants have to leave, now it's sitting vacant for 14 months, 24 months. Well, heck, if the lender forecloses, you're not going to be personally liable. So when you're looking for a DSCR loan, make sure you can close in a limited liability company and be able to sign this loan, get this loan without having to give a personal guarantee. Now, given that everything I said, you still have to have a decent credit score, all right? So this is something that throws people off. They say, well, Clint, why do I have to have a credit score of 620? The reason why you have to have a credit score of 620 because it proves to the lender that you pay your bills. That's why. So that is a requirement. They will run your credit when you apply for this loan. So don't think you can go out and get a DSCR loan. It's not going to hit your credit. It will. But if they're not reporting back to you, not signing a personal guarantee, then you're going to be better off for those next loans that you're acquiring. The next thing is going to be the down payment. So now you're going to need about 20 to 25% down. I know there's other loans out there that have a smaller down payment, but again, those come with strings attached. This is a great loan for investors, but there is this expectation that you have a decent down payment on the property. The minimum they say is 20%. What I've seen now, it's 25, even 30% that they're asking some of the lenders. If you're looking for more favorable rates and you want to be able to get into the loan without having to give it a personal guarantee, expect you have to put down a few more dollars on that. Now, when you apply for it, you will have to go through an appraisal and they're going to do a rent schedule. With a 1007 form, what they're going to look at is what are comparable rents in your area. Because let's assume you're buying a property that already has a tenant in it. It's easy to show that. But you may want to say, hey, I'm going to be increasing the rents on this tenant after the lease term's up in 2 months. And you tell them, hey, this is what the income should be on that property. Now, how do they verify that? Well, by running a rental appraisal, looking at 3 comparable properties to determine what that number is going to come in at. That's really important as well. And then, as I stated earlier, the DSCR ratio has to be equal to or greater to 1.1. In this market, really, I say right now, it's going to be 1.2 and greater is where we want to come in with these DSCR loans. So if you're a real estate investor, you're looking to get started in real estate and you've been running into issues thinking you cannot buy property. If you have the down payment right here, right, and you're looking at real estate, you may be able to qualify for this type of loan. It doesn't matter the numbers as far as how much income, it just matters about the ratio. Be sure to keep that in mind. Next time you go out to buy a piece of property, start questioning lenders, figuring out what the best rates are, how much you need down, what those ratios are, so you can start acquiring more real estate and help build your portfolio quicker. Guys, if you liked the video, hit the like button. Hey, if you have any comments, leave the comments in the section down below. I respond to my comments. And be sure to subscribe to the channel if you're not yet a subscriber. Take care, everyone.